We all know SCHD is already a beast of an ETF. It's one of the most popular dividend ETFs for a reason. It gives you passive income and strong performance. But what if I told you that you could supercharge your portfolio just by pairing SCHD with one or two other ETFs? In this video, I'll break down 4 of the best ETFs you can combine with SCHD to help you grow your wealth faster, boost your dividend income, and create a more balanced, diversified portfolio. Each of these ETFs has low overlap with SCHD, which means you're not just doubling down on the same stocks, you're actually expanding your exposure and improving your long-term odds. Let's get into it. Let's start with the foundation, SCHD. This ETF is built for dividend investors who want reliable growing income. It currently has a dividend yield of around 3.5%, and it's been growing that dividend every single year. That's the kind of consistency you want when you're planning for long-term income. And it's not just about dividends. SCHD has also delivered over 11% annual returns over the last 10 years and more than 13% annually over the last 5 years. That combo of income and capital appreciation, it's what makes SCHD a no-brainer as a core holding. But can it be even better? Yes, when you pair it with the right ETF. SCHD is heavy on value and dividend-paying companies. What it lacks is exposure to high-growth tech and innovation-driven stocks. That's where SCHG comes in. SCHG is Charles Schwab's U.S. large-cap growth ETF. It focuses on big-name growth companies like Apple, Microsoft, Nvidia, Meta, Amazon, and Google. These are the titans driving the future of the economy. Now here's what makes this combo so good. SCHD and SCHG have only a 1% fund overlap, so you're getting true diversification. SCHG has crushed it with over 16% annual returns over the past 10 years and over 20% annually over the past 5 years. When you combine SCHD's income with SCHG's growth, you get the best of both worlds, dividends plus high potential upside. If you had invested $100,000 in a 50-50 SCHD plus SCHG portfolio, you'd have over $370,000 after 10 years. That's a massive jump compared to around $290,000 from SCHD alone. If you want more balanced exposure, another great pairing is SCHD with VOO, Vanguard's S&P 500 ETF. Why VOO? Because it's basically a slice of the entire US economy, 500 of the biggest, most influential companies in every sector. It's hard to go wrong betting on the overall market. Here's why the SCHD plus VOO combo works. They have a low fund overlap of 8%, so you're still getting diversification. VEO's top holdings include Apple, Microsoft, Nvidia, Amazon, and Meta, offering you strong tech exposure that SCHD lacks. VOO focuses on both growth and value stocks, while SCHD is more value-focused. That balance helps even out your portfolio over time. With a 50-50 mix of SCHD and VOO, you'd be looking at over 12% annual returns over the last decade. That turns a $100,000 investment into more than $300,000, once again, outperforming SCHD alone. You might be thinking, isn't one dividend ETF enough? Honestly, not always. Not all dividend ETFs are built the same. SCHD focuses on consistent high-yield dividend stocks with solid fundamentals. DGRO, on the other hand, is all about dividend growth. Companies that are actively increasing their dividends every year. DGRO and SCHD have a 20% overlap, which isn't too high considering their shared dividend focus. But here's the benefit. DGRO offers more exposure to tech, financials, and healthcare, giving you sector diversification. Its holdings include names like Microsoft, Apple, JP Johnson & Johnson, and Chevron. DGRO has also delivered over 11% annual returns over the past 5 and 10 years. So pairing DGRO with SCHD is like saying, I want dividend growth and dividend yield. And if one underperforms, the other may carry the load. With a 50-50 portfolio, you'd still beat SCHD alone by a couple $1,000s over 10 years, all while keeping your focus on passive income. Now, this last one is a bit different, and it's perfect for investors who want high dividend income today, not just in the future. JEPQ is a covered call ETF from JP. It holds large-cap tech stocks but uses an option strategy to generate monthly income, resulting in a dividend yield of nearly 10%. Yes, 10%. It does have a higher expense ratio of 0.35%, but that's expected with a more complex strategy like this. The key benefit? Huge income now. The fund overlap with SCHD is just 5%, which means you're not repeating positions. JEPQ's top holdings are also big tech Apple, Microsoft, Amazon, Nvidia, and so on. Now here's the trade-off. SCHD gives you dividend growth and long-term appreciation. JEPQ gives you huge monthly income, but little to no dividend growth. It depends on your goal. If you're looking to retire early or just live off dividends now, this combo is killer. In just the last couple of years, this 2 ETF combo returned over 20% annually, much higher than SCHD alone. A $100,000 investment would have grown to nearly $140,000 versus $120,000 with just SCHD. Of course, JEPQ's performance might even out as time goes on. It launched during a bull market, but the income stream is very real. SCHD is already a solid long-term holding for dividend investors, but pairing it with the right ETF can take your portfolio to the next level. Whether you're chasing higher growth, broader diversification, or just bigger monthly paychecks. Here's a quick recap. Pair with SCHG for growth and tech exposure. Pair with VOO for broad market stability. Pair with DGRO for dividend growth. Pair with JEPQ for high income right now. Each of these combos offers something unique. And best of all, you don't have to pick just one. A balanced mix of SCHD plus one or two others could be the key to building long-term wealth while sleeping better at night. If you found this helpful, let me know in the comments what you're pairing with SCHD. And if you want to see exactly what's in my full $125,000 ETF portfolio, check out the Blossom app. It's free and linked below in the description. Diversification is a cornerstone of any robust investment strategy. By spreading your investments across various asset classes, sectors, and geographies, you can mitigate risks and enhance potential returns. Think of it like a safety net for your portfolio. If one investment underperforms, others can help balance the scales. Diversification helps you weather market volatility and protect your portfolio from significant losses. So, as you consider pairing SCHD with other ETFs, remember that a well-diversified portfolio is key to long-term financial success. Now let's dive deeper into the historical performance of SCHD and compare it with other ETFs we've discussed. SCHD, or the Schwab US Dividend Equity ETF, has consistently delivered strong returns since its inception. Its focus on high-quality dividend-paying companies has helped it outperform many of its peers during both bull and bear markets. For instance, over the past 5 years, SCHD has achieved an average annual return of around X%, which is commendable considering market fluctuations. When we compare this with VOO, the Vanguard S&P 500 ETF, which has an average annual return of Y%, we notice that while VOO might have a higher return during bull markets, SCHD provides a more stable performance during downturns due to its dividend focus. Next, let's look at DGRO, the iShares Core Dividend Growth ETF. DGRO has shown an average annual return of Z% over the same period. While DGRO focuses on companies that are likely to grow their dividends, SCHD's strategy of including only the highest quality dividend payers tends to result in slightly stronger performance during volatile markets. When we bring JEPQ into the mix, the JP Morgan Equity Premium Income ETF, we see a different strategy at play. JEPQ aims to generate income through options, premiums, and dividends, resulting in an average annual return of W%. This approach can provide higher income but may come with more volatility compared to SCHD's steady dividend-paying companies. By understanding these historical performance metrics, you can make a more informed decision about how to blend these ETFs in your portfolio. Each has its unique strengths and can complement the stability and income focus of SCHD. Remember, past performance is not indicative of future results, but it can provide valuable insights into how these ETFs might behave under different market conditions. Investing in ETFs, including SCHD, VOO, DGRO, and JEPQ, comes with its own set of tax implications that every investor should be aware of. One of the primary benefits of ETFs is their tax efficiency. Unlike mutual funds, ETFs generally incur fewer capital gains taxes due to their unique structure and the in-kind creation and redemption process. This means that when you buy or sell shares of an ETF, the transactions are made in kind, often avoiding the need to sell securities within the fund and triggering capital gains. However, this doesn't mean ETFs are entirely tax-free. Dividends paid by ETFs, such as those from SCHD or DGRO, are typically subject to taxes. Qualified dividends are taxed at the lower long-term capital gains rates, while non-qualified dividends are taxed at your ordinary income tax rate. It's essential to understand the breakdown of your ETF's dividend income to manage your tax liability effectively. To optimize your tax situation, consider holding ETFs in tax-advantaged accounts like IRAs or 401(k)s. This can help defer taxes on dividends and capital gains until you withdraw the funds, potentially lowering your overall tax burden. Additionally, utilizing tax loss harvesting strategies can offset gains with losses, further reducing your taxable income. Always consult with a tax advisor to tailor your investment strategy to your specific financial situation. By being mindful of the tax implications, you can maximize the after-tax returns from your ETF investments and achieve your financial goals more efficiently.